Well, thank you very much, Martin. That is very kind, and it is great to be back. He's right. I've spent a lot of time here over the years, less so since I became governor, but still always look forward to it. Here in St. John's, truly unique corner of our country, great folks and great food, and wow, what the air was like this morning. That's a real treat from where we came from. It's been very hot and stuffy. Well, given the city's geography, its history, its rich culture, those of you who get to call St. John's home, I think, are fortunate indeed. And the idea of home is a preoccupation for us at the Bank of Canada. And we've been working since the global recession, almost a decade ago now, to bring the economy home. And what I want to do today is to give you a sense of how far the Canadian economy has come, how much further it has to go, and talk about some of the signs to watch for along the way. Now, the goal of our monetary policy is to keep inflation low, stable, predictable. Under the terms of an agreement between the bank and the federal government, we aim for an annual rate of consumer price inflation of 2%. Now, of course, unforeseen events can always push inflation up or down. So our agreement sets out a target band of 1% to 3%. Now, what do I mean by bringing the economy home? Well, for us, home is at the intersection of full capacity and 2% inflation. Now, we expect that when the economy reaches full capacity, inflation will converge on the 2% midpoint of the target band. And that's why we're so preoccupied with this idea of home and getting there. Now, our adjustments to interest rates affect economic activity. This affects the gap between the level of economic activity, or output, and full capacity. And that gap, in turn, affects inflation. Now, that's all pretty standard, but there's an important consideration that sometimes gets lost. This process takes time. Now, any change in interest rates will not have its full impact on inflation for about 1.5 to 2 years. So when we make our monetary policy decisions, we're a lot less concerned about the latest inflation numbers, which after all are already a month old, than we are about where inflation will be in the future, 1.5 years or 2 years from now. So that brings us to the obvious question of how to forecast future inflation. Well, the place to start is with economic models. And models, they're indispensable for developing forecasts of inflation and for the rest of the economy. But no central banker would ever base a monetary policy decision solely on a projection from an economic model. The models provide us with a coherent starting point. Everything fits together. But we need to apply real-world judgment before reaching a policy decision. And a lot of that judgment, well, it comes from conversations with people. Earlier this year, our Deputy Governor, Lynn Patterson, gave a speech about how the bank gleans intelligence from financial markets. But equally important are efforts to gauge business sentiment, sometimes we call that soft data, and to gather intelligence about the real economy from business leaders. Now, we need to understand the view from both Main Street and Bay Street to help inform our outlook for growth and inflation. And this is where our regional offices, staffed by people who routinely visit companies across the country, play a vital role. Now, one of the most important vehicles for those efforts is our Business Outlook Survey, which we call BOSS for short. It's celebrating its 20th anniversary this year. Now, the informal process for these visits to business leaders began when I was at the bank, my first time, back in the early 1990s. In fact, the first time I got to visit St. John's was to do some of those consultations back in that time frame. Now, through our surveys and conversations with business leaders, we regularly get clues about economic trends long before they show up in the official economic statistics. So let me illustrate. So the 50% drop in oil prices during 2014. Well, that represented a cut of roughly $60 billion per year in export revenue for Canadian oil producers. 60 billion. Now, some of the impacts of this cut were immediately obvious and predictable. We knew that oil-intensive regions would be hurt, of course, by the drop in income, and that oil companies would reduce their spending, investments in new projects, and so on. Certainly, the people of this city and province are aware of the pain caused by the oil price shock. However, the boss taken late in 2014, together with additional discussions we had with energy companies, revealed warning signs that went well beyond the decline in business investment in the sector. For example, companies in this region told us they were being flooded by resumes of workers returning from Alberta. Service firms, such as hotels, trucking companies, told us about bookings that were suddenly canceled. Energy service companies told us that previously signed contracts for construction and exploration work were either being renegotiated or terminated. So well before the shock started to show up in the official statistics, we could see that it would have a significant negative impact on the Canadian economy more broadly and, of course, for the outlook for inflation. So this input was crucial to our decision to lower interest rates in January of 2015. And as companies cut their investment intentions even further, we lowered interest rates again in July of 2015. Now, to be clear, our economic models correctly predicted that the collapse in oil prices would be a serious blow. Specifically, our main projection model gave us invaluable insights into how the shock would affect the economy and how the subsequent adjustments would unfold. But the fact that everything we were hearing from our contacts was supporting these insights increased our confidence that cutting rates was the right course of action. Now, obviously, the drop in oil prices was a significant detour for the Canadian economy if you're thinking about the path home. We knew that the shock would trigger a complex series of adjustments and it would create significant hardship for many people. Basically, our models projected that the economy would go through the reverse of its experience from 2010 to 2014. During that time, when oil prices were really high, that led to strong increases in business investment and national income. And provinces where the energy sector is relatively more important, such as Newfoundland and Labrador, would feel these effects most acutely. So this underscores what I think is the most fundamental challenge for policymakers, and that is that economic shocks that hit the economy can have very different implications for different regions of the economy. In terms of adjustments, we anticipated that lower oil prices would mean not only a decline in the energy sector, but also a pickup in growth in other sectors. We expected exports to be boosted by a lower Canadian dollar. And as exporting companies would reach their capacity limits, then we would expect to see stronger business investment in those companies. Stronger exports and investment would complement household spending, and growth would become more broadly based and self-sustaining in the wake of the shock. Now, we all know that adjustment in the energy sector has been painful and remains painful. Beyond cuts to investment spending, oil companies restructured operations and laid off many workers. Employment in the resource sector fell by roughly 50,000 jobs from the beginning of 2015 until around the middle of 2016. Despite this, companies managed to boost production and exports of crude oil as earlier investments were completed and as they found greater efficiencies. And since oil is priced in US dollars, the decline in the Canadian dollar also helped cushion the impact of the shock here at home. So the increased output and the weaker Canadian dollar helped to offset almost half of that $60 billion decline I talked about before, boosting exports by about $25 billion. But that said, Canada's other exports took longer to recover than we anticipated. Exporting companies had taken a significant hit both during and after the global financial crisis. many of these companies disappeared, to be replaced over time, much more gradually, by new firms exporting new goods and especially new services. And as a consequence, the composition of Canada's exports has also changed since the crisis. Exports of services in particular, in categories such as technical or engineering services, travel services, financial and management services, these areas have taken the lead in growth, while some traditional goods, such as motor vehicles and parts, have seen their shares decline. Now, by mid-2016, so about a year ago, non-energy exports had fully recouped their previous drop. And today, total exports in Canada are almost 10% above the pre-crisis peak. But as I said, the composition is very different today. Now, monetary policy has played a key role in this adjustment process. Now, we estimate that if we had not lowered our policy rate in 2015, the economy would be roughly 2% smaller today, a difference of some $50 billion. And there would be about 120,000 fewer jobs in Canada. Government fiscal stimulus measures also contributed importantly to growth, and this has meant a better mix of monetary and fiscal policy. Without this fiscal stimulus, interest rates would have had to have been even lower than they were. All things being equal, this would have meant even more household debt and an increased longer-term vulnerability for our economy. Well, now, as we look ahead, we project that business investment will be a key driver of economic growth. Business investment was also slower to materialize than we originally expected, but it's been strong across the board over the first half of this year. Furthermore, in our most recent BOSS, our regional staff found the companies were much more focused on expanding capacity than they were previously. Indeed, business across an increasing range of sectors say they expect sales growth to improve further, and hiring intentions have reached a record high. So given all of this evidence, we could see by the beginning of summer that the economy's adjustments to lower oil prices were essentially complete. Now, to be clear, the impact of the shock was and still is visible in energy-intensive areas of the country. But this is being offset at the macro level by greater strength in other areas. So in July, and again earlier this month, we raised our key policy interest rate. Now, between those two rate hikes, we saw a long string of stronger than expected economic data, culminating in the GDP report at the end of August, which showed an annual growth rate in our economy in the second quarter of 4.5%. Now, as we noted in our most recent interest rate announcement, this pace is unlikely to be sustained. And recent data point clearly to a moderation of growth in the second half of the year. But still, the expansion is becoming more broadly based and self-sustaining. And it's important to remember that it's the level of output relative to potential or capacity that drives inflation, not the growth rate of output. We're in the process of developing an updated forecast for growth and inflation, and it will be published in next month's monetary policy report. Now, despite the recent news about economic growth, the story of inflation in Canada over the past few years has been dominated by downside risks. In fact, for most of the past 5 years, inflation has been in the bottom half of our target band. Now, bearing in mind the long lags I mentioned before, the long lags between economic activity and inflation, much of this low inflation has been due to slow economic growth in the past. More recently, it's also reflected temporary factors, such as weakness in food prices and especially in Ontario in particular, electricity prices. In fact, inflation has been surprisingly soft recently in much of the developed world, not just in Canada. So I'll have more to say about that in a few minutes. But since inflation has been so consistently in the lower half of the target band, our risk management approach to monetary policy led us to pay greater attention to forces that are pushing inflation down. The reason for that is simple. It's because when inflation is already low, any negative shock to the economy, to the outlook for inflation, will have a more significant policy consequence than if it were a positive surprise. Throughout, we wanted to be sure that our policy would be sufficiently stimulative to get the economy home. And as the expansion continues, we'll continue to manage the evolving risks to the inflation outlook. The temporary factors that have been holding inflation down should dissipate in the months ahead, although recent exchange rate developments could affect the timing of that. In our July projection, we forecast inflation will reach close to 2% by the middle of next year. But since that projection, the bank's measures of core inflation have edged higher, as expected, and we expect the downward pressure on inflation over time to shift to upward pressure as economic slack is used up. Indeed, our models forecast a very slight overshoot of our 2% target in 2019, and that's a product of our model's dynamics. Now, the appropriate path for interest rates in this situation is very difficult to know, because there are a number of important unknowns around the inflation outlook. These unknowns are unusual. They're the product mostly of the unusual nature of the situation that we find ourselves in. The legacy of the global financial crisis, the protracted period of slow economic growth, and extremely low interest rates, and so on. Accordingly, we need to keep updating our understanding of the economy in real time. And that's why we say that the outlook for inflation, and therefore the outlook for monetary policy, is particularly data dependent right now. So what does it really mean in practical terms, data dependent monetary policy? Well, after all, central banks always depend on data to measure their economy's progress relative to their expectations. But what I mean in this context is that in a period of heightened uncertainty about how the economy is evolving and the implications for inflation, we need to pay very close attention to all the information we receive, and this would include hard data, sentiment indicators, and of course, intelligence from companies. And we need to be making continuous inferences about not just how the economy is evolving, but how its underlying behavior may be changing. So let me give you 4 examples of the issues that we'll be monitoring carefully. The first and most important is the evolution of economic capacity. And I said that our version of home is at the intersection of full capacity and 2% inflation. But full capacity can be a moving target. And that's because when companies increase investment, they end up augmenting their capacity to produce through some combination of raising productivity or increasing their workforce. Now, this is a very welcome development because as the economy approaches full capacity, investment spending can have the effect of pushing out those capacity limits even further. And that gives the economy more room to grow, more jobs to create in a non-inflationary way. In short, this is something worth encouraging. And to some extent, this happens at this point in every economic cycle, but the protracted cycle that we've been through makes this issue particularly relevant this time around. Now, a second issue is the question of inflation and technology. Some economists have cited technology as contributing to the weakness in global inflation. So the digital economy, it may be allowing goods and services to be produced and delivered more efficiently, and that would help keep prices down. We may also be seeing stronger competition through e-commerce, which affects how retailers set their prices. Now, it's worth emphasizing that this type of disinflation increases everybody's purchasing power, and therefore is also a very positive development. Now, the bank would want to estimate the impact of technological developments like this on trend inflation, and assuming that that impact was temporary, we would want to see through it, provided that inflation expectations remained well anchored in the process. Now, there's a lot more work to be done to understand both the size and the persistence of these technological effects, so stay tuned. A third issue is wage growth. Wage growth has been slower than would be expected in an economy that's approaching full capacity. Hourly wages increased at an annual pace of 1.7% in the second quarter of this year, and growth has been subdued for months, although there were signs of an increase in the latest monthly employment report. But this slow growth is likely due in part to employment shifting from higher-paying jobs in the oil sector to somewhat lower-paying jobs in other sectors. That's an important phenomenon to track. And how long this effect will continue is not clear. And of course, other phenomena may also be at work. Again, we must work hard to understand these data and the underlying shifts in behavior that they might be pointing to. The fourth issue is elevated household debt. Now, we're all familiar with this one. There's reason to think that with all that debt, interest rate increases may have more of an impact on the economy and therefore on inflation than they did in the past. Further, we don't yet know the full extent of the economy's reaction to the various macroprudential measures aimed at imbalances in the housing market. So the bank will be looking closely to see how the economy's adjustment to those changes, both in interest rates and those other macroprudential changes, may differ from what's happened in the past, certainly in previous economic cycles. Well, those are four key issues. It's not an exhaustive list. There are also many external risks and uncertainties around our outlook, including geopolitical developments and, of course, the rise of protectionist sentiment in some parts of the world. Also, the evolution of the neutral rate of interest is a topic of significant debate in the profession. And we've been talking about all these uncertainties for some time. We're working on them. But in such an environment, we simply cannot rely mechanically on economic models. Now, that doesn't mean we're abandoning our models, but it does mean that we need to use them with plenty of judgment, informed by data, by sentiment indicators, and intelligence, as we go through this delicate process of bringing inflation sustainably back to target. We'll continue to watch all the data closely, as well as developments in financial markets in terms of their impact on the outlook for inflation. We recognize that the economy may act differently than in previous cycles. We will not be mechanical in our approach to monetary policy. So let me quickly make one final point. Among the financial market developments that we watch closely are movements in longer-term interest rates and in the exchange rate. Changes in interest rates naturally lead to movements in the Canadian dollar. However, currencies can move for many other reasons, including external factors, things going on outside of Canada. And these movements can affect our inflation outlook, depending on their cause, their size, and their persistence. So it's time for me to conclude. I hope I've given you an appreciation of just how far the economy has come on its way home. And although we are confident that the economy has made significant progress, we simply can't be certain of exactly how far there is left to go. The economic progress that we've seen tells us that the moves we took to ease policy in 2015 were the right thing to do. At a minimum, that additional stimulus is no longer needed. But there is no predetermined path for interest rates from here. Monetary policy will be particularly data-dependent in these circumstances. And as always, we could still be surprised in either direction. We'll continue to feel our way cautiously as we get closer to home, fostering economic growth and keeping our inflation target front and center. Thank you very much for your kind attention.
Thank you very much for that address, Governor. So we do have a couple of minutes left, and we did say we would open the floor for any questions for the Governor. So Laurie is around. Oh, I see Margie back there for questions, and Nancy is there. But I have one to sort of kickstart. And I've been taking some notes as you were talking, and you did talk about your economic models and the 4 factors that you had considered of the capacity, inflation, technology, wage growth, and household debt. In your economic model, I guess, and talking to what's occurring right now with respect to the proposed federal tax changes, does the implication of taxation factor into that model, or how do you factor that with respect to calculation of interest rate changes?
Well, much as I know that's your favorite topic, you know, it's at this stage, it's really not a question for me to address. We don't really know what changes might look like. They're under consultation, so we'll watch that process with interest. We always take account of the fiscal situation in our forecast, as any good forecaster must do. But we take it into account when we know what it is specifically. So that would be built into an economist's forecast what the economy would do, and then monetary policy, of course, conditional on that outlook as I described here today. And I know that's not answering your question. Okay.
I had to ask. You knew I had to ask, right? I know, you knew I had to ask. I don't know if anyone from the floor has any questions. Do we have anything? You do? Okay, all right.
Governor, in your remarks, you mentioned household debt. Can you comment just how concerned you are about the levels of household debt across the country?
So, yeah, well, this is our number one risk from our financial system review, which we put out twice a year. It's the level of household debt is high. The way we normally think of this is it's a bit like it's like a crack in a tree. You know, you might have a nice big old tree with a bit of a crack in it, and as long as things are okay, that tree continues to look lovely. It may even mend itself through time. However, if the right kind of storm comes along, then the tree can crack fully, and of course land on your neighbor's house. And that would be a bad day for everybody. So the way we analyze this is with a high level of indebtedness, the Canadian economy is not well prepared for a negative shock to the economy. So sorts of shocks we have in mind would be like a recession where unemployment rises, let's say, by 2 or 3 percentage points. People have difficulty, you know, paying their mortgage because they're laid off, and then that becomes a problem for the financial system. Okay, because, you know, so we simulate these things, and I can assure you that our financial system is extremely resilient, very well buffered for such events, but that doesn't change the fact that it would be a shock that would be quite difficult for Canadians who are carrying those debts. So right at the moment, what we think of it is that indebtedness is a factor that's beyond the ordinary. Normally, the interest rate effect on the economy would assume there's a certain amount of debt out there because that's how it has its transmission. But now that it's higher, we have to be aware that the possibility is that the economy will react more to the same amount of interest rate movement than in the past. And so that's another reason why we have to be cautious as we look forward and continue to analyze that. And we're building those effects into our models so that we can kind of test the downside as we go along.
Check and see if there's any more questions. Governor, with respect to our gray tsunami that we talk about that's facing us in the demographics,
I have no idea what you're talking about.
And the demographics in Canada, how is that factored into your model with respect to what's approaching us demographically?
Yeah, that's very clearly there. That's an important issue. It's a very slow-moving. Well, it's moving faster now, but the point is, and it's not like in a short-term kind of forecaster sense. That what has happened is for the last 50 years or so, we've had a big bump in labor force participation from the post-war period. So about 15 years after, so around 1960 or thereabout, the baby boomers hit the workforce, and now the baby boomers are in retirement mode, and so the rate of growth of our labor force is falling steadily. Okay, it's of course held up by levels of immigration. Okay, so in fact there will come a point when it's being held up only by immigration. But for now, there's still some labor force growth, and that's what we call non-immigration labor force growth. So this fits in this way. 10 years ago, I would have said that capacity in the economy would be growing at perhaps 2 to 3%, 2.5%, something along those lines. And today, we'd say that actually capacity is only growing by about 1.5% per year. So that means, and that's because the ingredients of growth are productivity growth, as we mentioned before, from companies investing, and labor force growth. The labor force growth is slower, so that trend line is slower. And this is true for everybody, right? Not just Canada, of course. We're not the oldest nation by any stretch. So that trend growth rate, that's kind of like when we get home, our projection is that's the best we can hope for, is around 1.5% growth per year for Canada. Long term until something else changes. But the good news is that we have ways of perhaps boosting that trend line. So for instance, interprovincial free trade, which we've just launched on July 1st, has the capacity, we think, to bump it up by 0.2 or 0.3 per year. That's real money. Think about your kids living under 1.5% for a generation. Instead, they could have 1.7 or 1.8. Well, that's a free trade agreement worth getting done, don't you think? And it's those kinds of things that can add to the trend line because it creates greater opportunities and less inefficiencies or roadblocks to growth, more productivity in effect. So it's embedded in our forecasts. It's part of that definition of where we're heading to, which we call home.
Okay. Are there any other questions from the floor? Oh, Sandy.
Governor, thank you for coming here today. I have a question on the concept of sustainability. And I heard Martin talk about fish industry and sustainability. And from the United Nations, there's 3 pillars of sustainability: society, the environment, and the economy. And the environment is basically Canada for us because we're a resource-based economy. Although in Ontario, I guess there's manufacturing. So, and being a past president of the Board of Trade, and Dorothy, my accountant, we often talk a lot about the economy and how you do it. But in the broader context of sustainability, and sustainability being a definition of kind of continuance into the future, getting home, always being home, what kind of influence do you have, or do you influence, those 3 pillars, and not necessarily that the economy or the taxes or how our economy leads everything? What kind of influence, or what kind of influence can be had on us being a sustainable province and a sustainable country, making use of our environment and the natural resources that we have to work? So it's just a broad kind of statement, but what kind of influence do you have on that type of thing?
Just a simple question to end off on, I suppose. Before I answer that question, are there any other questions? Because I'd really rather answer a different one. You said you were going to ask me, what do I read? What do I read at night or something like that? What's this? Okay, so sustainability is, as you could tell from your question, is a very complicated concept, and it figures in very many dimensions. And so certainly as someone who cares about the long-term evolution of our economy, we care a lot about the sustainability issue. For us, it's kind of a narrower concept, which is we know that if we believe 1.5% or maybe a little more is the trend growth rate, we can't sustain 2 or 3% growth. We would cause inflation if we tried to. So that's an important concept of sustainability. Or on the financial stability side, it would be unsustainable if it meant everybody was going to have, twice as big a mortgage as they have today in order to create growth. Well, we know there would be a sustainability issue there. In the broader sense of sustainability, which relates to resource endowments and how we deploy them, we think of our resources as endowments or gifts. That's the natural resources, and people. And we combine those things with our ingenuity to make the best of what we can do. And sustainability, hard to define, but we are mindful of that we couldn't exploit some resource, to the maximum and then exhaust it. That wouldn't be sustainable. So that it comes into that trend line that I talked about a few moments ago. So for us then, it enters in a way, not in a, let's say, a rigorous way, but as a limiter. It enters in that way. And, some new discovery, let's say, just for instance, I suppose, I'm sure everybody's a Star Trek fan. If we were to discover dilithium crystals in Labrador somewhere, I mean, that would be quite the thing, right? The only place on Earth where they have dilithium crystals. Well, you can imagine. Just think about it. So they have them on Star Trek, so they know they got them from somewhere. But anyway, the point is that would break that bounds of sustainability in a very fundamental way. Or if you create a new technology that doubles the efficiency of fuel use, you can create prosperity growth, in effect, for free from that new technology. And it's a good lesson there, because we've seen technologies change in our lifetimes, and of course, many lifetimes before us. And every time there's been a major technological change in the world, it has created more jobs than it has eliminated, every time. And so most of those jobs, you never even thought about them. Your kids are learning things and going to have jobs you never thought of before, right? And so we can't be narrow in our thinking around how technology works. Anyway, I know that's a bit of a sidestep question, because that's a hard question. I did what I could. Yeah.
So the governor is fine if there's one more question from anyone. Give another moment. Is there anyone with Nancy?
There you go.
Okay.
What do you read?
What do I read now? Okay. No, what keeps me awake at night really is, I would say that the one I take most personally is youth, unemployment, and probably more importantly, underemployment. We've talked a lot today about the length of this business cycle. Really starts, in 2008. And yes, we got bumps and wiggles along the way, but it's really just been a tough go to get back to normal, or to home, as I described it. And we aren't even there yet. And throughout that, one of the, in the Canadian economy, one of the big casualties has been youth employment. So the young folks, that talk about people from 15 to 25, about 4 percentage points of those have dropped out of the labor force. So that means they're not actually even now looking for work. So they're decidedly discouraged. And that's because of how long this has been. And those are the sorts of scars that one can carry, into adulthood. And those who have jobs may not be employed in their field that they've studied so hard for. They may be only working part-time when they'd much rather work full-time. So we're hopeful that as we go through this phase, I just talked about expanding capacity because the economy is running well and we're getting the investment now, that every time a company says, well, I think I should increase my capacity by 5% or something like that, that creates new jobs. And we're hopeful that these are the folks that will be drawn back in to the workforce. And that's more or less the situation that has happened in the United States over the last 18 months. The economy's been running strong, and the economy has run beyond what we used to think was capacity. And in our case, it wasn't so much the youth, but it was more the adult workforce, adult males, who have been drawn back in over the last 18 months in a very positive way. So we'll all be better off, if we can allow the economy to achieve all that. And for me, personally, I won't feel satisfied until I see signs that that's happened. So that keeps me awake at night, yeah.